Okay, good morning, everyone. Thank you for joining us today. Sorry, we're a little behind schedule just by a couple minutes, but we always like to wait a little bit for more people to join. So we're going to start right now. So this is the 9th webinar from our fiscal webinar training series. So 9 out of 10 right now that we have scheduled. So today's presentation, we'll be discussing service level exemptions. This webinar is being presented jointly by the California Department of Education's Early Education and Nutrition Fiscal Services Unit of the Fiscal and Administrative Services Division and the Early Education Division. So for those that do not know me, my name is Corey Kahn, and I'm the manager over the Early Education and Nutrition Fiscal Services Unit, which we also call ourselves for short EENFS. So today I'm joined by the EENFS fiscal analysts and managers, which also includes one of our presenters, Jacob Lee. And then we also have Crystal Devlin, who will be presenting from the Early Education Division. So note that we have disabled the chat box for participants, although CDE staff will be using this feature to share links with you there. And as we've, as I've said for the past couple webinars, so our team is committed to being as responsive as possible. There are some webinars where we are able to get through all the Q&A, but there are some where we do not, just given our time constraints. So please utilize the Q&A feature to ask us questions and give us as much detail as possible before clicking that submit button. At the end of the presentation, we have one of our managers, Lucy Mosqueda, who will be facilitating a live Q&A session. And, if we have any frequently asked questions that have come through during the session, she'll bring them up, she'll raise them there at that time, or we can also call on participants that have raised their hand. If we aren't able to get through all of the questions, we'll take them back and reach out to you later, or we may use them to develop frequently asked questions on our website. So we do ask that when you submit your question through the Q&A, that you include identifying information like your vendor number or agency name, so that we can follow up with you in case we have any, in case we did not answer your question during this webinar. So before we get started, again, I want to take a moment to announce our webpage that we created that's dedicated to fiscal webinars and trainings. So this webpage can be found at https://www.cde.ca.gov/FG/AA/CD/webinars and trainings.asp. So this link has been posted in the chat. And as we have the past webinars, we've been recording them. And one of our team members, Jenny Tran, has been working on transcribing the webinars for posting. So right now we have 6 of our past 8 webinars posted, and we'll continue to record them and we'll post them as they become available. So when you navigate to this page, right now you'll find 3 columns. It identifies the date in which the webinar took place, a link to the recording, and then a summary of the training topics covered. So, for example, our first webinar took place on November 13th, 2024. It was called Enrollment, Attendance, and Fiscal Reporting Requirements, where you see the link to that in the second column. And then the topics that we went over were reporting requirements, enrollment and attendance source documentation, and revenue and expense source documentation. What you don't see here is a 4th column, so we will be adding another column to the right, and that's where we're going to be posting some of the frequently asked questions that we received, and we're working on sorting them by topic. We plan to release that after the last webinar, just so that we have all the questions that have come through during all the presentations, and then we'll post it within this grid as they become, as we've sorted them and they're available for posting. So you don't see that now if you navigate to the page, but you will probably, and I'd say at least we have to get through next week's webinar. So after that, maybe a couple weeks from there. So as a recommendation, these are being posted as they become available. Contractors, you guys can periodically navigate to this webpage just to see if any others have been posted beyond the 6 that are there right now. So now I'm going to turn it over to your presenter for this morning, which we start off with Jacob Lee.
Thank you, Corey, and good morning, everyone. My name is Jacob Lee, and I'm a fiscal analyst in ENFS. Today, my colleague Crystal Devlin and I will be presenting on service level exemptions. During this presentation, we will discuss what is a service level exemption, the types of service level exemptions, such as startup and staff training, how to report these service level exemptions, service level exemption requirements, such as prior approvals, the impact on contract reimbursement, and finally, some resources. So, service level exemptions allow the contractor to be reimbursed for identified expenses without the required enrollment to earn it. Service level exemptions may be needed because the California Code of Regulations, Title V, Section 17812, states that contract reimbursement is limited to the least of the following: the contract maximum reimbursable amount, otherwise known as the MRA, which is stated in the annual preschool contract, the net reimbursable program cost, or the product of the adjusted child days of enrollment, CDEs, for certified children, times the contract rate per CDE, times the actual percentage of attendance plus 5%, but in no case to exceed 100% of enrollment. And this is referred to as the service earnings. However, since fiscal year 2021, determination of contract reimbursement has been limited to the lesser of either 100% of the contract maximum reimbursable amount or the net reimbursable program costs, which we have referred to contractors being held harmless from the service requirement. As such, service level exemptions have not had an impact on contract earnings, but hold harmless is expected to end on June 30th, 2025, so at the end of this fiscal year, and therefore service level exemptions may be necessary moving forward. So there are 2 types of service level exemptions that increase the third limit of reimbursement, service earnings, without having the enrollment to support it. These 2 service level exemptions are for startup and staff training. Please note, contractors should be aware that because fiscal year 24-25 is a hold harmless year, where service earnings are calculated but not considered a limit of reimbursement, service level exemptions will not have an impact on contract earnings. So first, we'll discuss the first service level exemption, which is startup. The California Education Code Section 8205 defines startup costs as expenses an agency incurs in the process of opening a new or additional facility before the full enrollment of children. Startup funds are most commonly requested when a new or existing contractor has been rewarded RFA funds, or if a contractor relinquished their funding and an existing contractor has been awarded those funds. Pursuant to Education Code Section 8255, startup costs may be approved for an amount not to exceed 15% of the expansion or increase. For example, if an agency received an RFA award of $100,000, the maximum startup that could be approved for that would be $15,000. Contractors are not required to request the maximum allowable amount. However, startup requests cannot exceed the maximum allowable amount. Startup is a contract term and must be pre-approved. Contractors must submit a line item budget and written justification for approval to their fiscal analyst. Once this is approved, contractors will receive a contract amendment reflecting the approved startup amount. This amendment would need to be signed and returned before contractors can begin reporting startup expenses. Education Code Section 8255 also states that under no circumstances shall reimbursement for startup costs result in an increase in the agency's total award amount. As such, startup is not an additional funding, but is part of the contract MRA. Startup funds must be used within the fiscal year it is approved. Any unspent startup funds cannot be used in subsequent fiscal years. Education Code Section 8255 specifies that startup can be used for the following uses: the employment and orientation of necessary staff, the setting up of the program and facility, the finalization of rental agreements and making of necessary deposits, the purchase of reasonable inventory of materials and supplies, and finally, the purchase of an initial premium for insurance. Okay, so the line item budget is one of those two required documents contractors must submit with the startup request. The line item budget request should include the quantity, unit cost, and total cost of the item. Certain listed line items will not require a quantity or unit cost. For example, the startup request may include a line for office supplies in the amount of $1,000. The budget listed in the line item request does not need to include the quantities or unit costs of the different supplies purchased. Some examples of expenditures that would need itemized details. So you have staffing and personnel, which costs $2,420, and that's broken up by having one teacher at $17 an hour for 20 hours, one site supervisor at $20 an hour for 20 hours, and then finally one center director at $28 an hour for 60 hours. And that would total the $2,420 for that line item. Then you have the computers and software, and that's totaling $1,050. And what that entails is one desktop computer at $500, one desktop color printer at $150, and then finally one enrollment software at $400. Now let's go over how that would look on the line item request form that gets submitted to your fiscal analyst. So here we have an example of a line item budget request form. This example shows a contractor that was awarded expansion funds of $2 million, as you'll see there in that box. They're requesting $300,000 in startup allowance. You'll see that there. And then because 15% of the newly awarded funds is $300,000, the contractor has requested the maximum that would be allowed. Below the award and startup allowance request amount, the contractor will list the items they wish to purchase with startup funds, which must total the requested amount of $300,000. This contractor has listed classroom furniture for $50,000, facility repairs of $50,000, rent at $50,000, education supplies at $25,000, center supplies at $25,000, and then personnel at $100,000. So note that the contractor may request less than the maximum allowable startup if startup costs are less than what is allowed, or if the contractor intends to provide enough services to children where a service level exemption would not be necessary. This line item budget request will need backup documentation as well, which can be provided in the form of an Excel file, and we'll go over that next. Okay. So here we have an example of backup documentation that was sent to support the line item budget request. What we will be going over is only an example of how a budget detail can be formatted. There is no real requirement that a line item budget detail needs to look exactly like the example we will go over. This is just a suggestion. First, you'll see that this contractor created a separate tab for each cost identified on the request form, and that's going to be right there below. So focusing on the first item listed on the request form from the previous slide, the contractor has created a tab labeled Furniture. The Furniture tab of the Excel document shows that the total expense is estimated to be $50,000. And this, we've included a breakdown of the items they plan to use the startup funds for. The detail includes the item right there, the count or quantity of the item, eh, the cost per item, and the total for the item. Please note that if you are requesting startup for items that exceed the equipment purchase request threshold, as stated in the annual contract terms and conditions, you will need to also request prior approval from your PQI consultant before our office can move forward. Crystal from EED will be discussing more about the threshold and approval process shortly, but first let's take a look at an example of the justification form. So in addition to the line item budget request and budget detail, contractors must also submit a startup allowance budget narrative justification to their fiscal analyst. On the slide is an example of a startup allowance budget narrative justification. A justification should be provided for each line item requested. As we know, this contractor requested $50,000 of startup to be utilized for classroom furniture. So here we see they included the following justification with their submission. So it's for classroom furniture, it's going to be purchases to include desks, children chairs, classroom tables, small and large carpets, and adult chairs to meet the care and developmental needs of CSPP children. Other smaller furniture items include storage baskets, shelves, carpets, trays, and teacher filing cabinets. These items are necessary to fill in classrooms and provide the necessary storage for the classroom materials and to provide places for the children to learn and develop. The budget narrative should justify the need for each requested line item. Okay. So once the startup request has been approved, the contractor will receive a contract amendment. This will reflect the addition of startup. Depending on the timing of startup approval, the startup may be included in the original contract or a subsequent contract amendment. In this example, the contractor already had a CSPP contract and the additional funding and approved startup was being added to the contract by way of a contract amendment. In this presentation, we will not be going over the contents of this entire amendment. For information on the contents of a phase sheet, please refer to the contract and payment process webinar that was conducted on December 4th, 2024. The recording of this webinar can be found on the Early Education Fiscal Webinars and Trainings webpage that we went over there at the beginning. And there's also a direct link in the chat. What we will focus on is the following. In this example, this is the first amendment, and is indicated Amendment 01, which is at the top. A few rows below the amendment number, you will see a reason, and in this example, this amendment is for RFA number 7, award and startup. If you remember from our line item budget request, this agency received an award of $2 million. This award is reflected within the body of the phase sheet, as indicated that the maximum reimbursable amount is increasing from $500,000 to $2,500,000. Because the contractor was approved for $300,000 in startup, the following statement was added to the contract phase sheet. Up to $300,000 of the MRA may be expended as a one-time only startup cost in accordance with the contract terms and conditions. Lastly, this contractor will need to sign and return this amendment in order for the terms to be executed. Once startup has become a term of the contract, contractors can begin purchasing approved items from this line item budget. As the items are received, contractors must report on the startup expenses line in the reimbursable expenses section of the enrollment, attendance, and fiscal report. Note that these startup expenses should not be reported in expenditure categories 1,000 through 5,000, 6,100 and 6,200, 6,400 and 6,500, but only on the line designated for startup expenses. In the example shown on the slide, we can see that the contractor has expended 50,000 of the 300,000 approved for startup. The 50,000 reported on this line is not included in expenses reported in categories 1,000 through 5,000. I will now hand it over to Crystal, who will be covering prior written approval requirements and equipment purchase approvals.
Thank you, Jake. Good morning, everybody. We will now talk about the requirements for prior written approvals. And so for equipment purchases and equipment replacement purchases, contractors must request written approval from the CDE prior to using contract funds when the per unit acquisition cost equals or exceeds the lesser of the capitalization level established by the contractor for financial statement purposes, or $5,000 including tax, and or when the sum of all items included in the purchase equals $10,000 or more, including tax. All expenses associated with the purchase that are necessary for the equipment to perform its intended purpose prior to cost allocation must be included in determining if prior approval is required and subdividing equipment purchases into separate items to avoid the pre-approval requirement is prohibited. Contractors that are private agencies must obtain 3 bids or estimates for all equipment purchases, replacements, and improvements exceeding $5,000, including tax, when they are not performed by the contractor's staff. Each bid or estimate must contain prices for equivalent and comparable items and/or services. When available, consolidating procurements to obtain a more economical purchase is required. And again, subdividing equipment purchases into separate items to avoid the competitive bidding requirement is prohibited. Bids or estimates are required. The goods or services must be purchased from the lowest responsible bidder or estimator. If 3 bids or estimates cannot be obtained, the contractor needs to provide adequate documentation of the reasons why, such as there's an emergency situation or the item is only available from a single source. Lease purchase agreements are also subject to all of these requirements. Public agencies must comply with the Public Contract Code for purchases. Public agencies are our local educational agencies, LEAs, which include school districts, county offices of education, community college districts, and direct funded charter schools. When requesting approval for purchases, contractors must complete and submit the Equipment Purchase Approval Request Form, or the EPAR form. A justification letter shall be attached to the EPAR when submitted to the CDE for approval and should include the reason for the purchase and a cost allocation table for any equipment that will be used by more than one program type. So if the contractor has more than one type of funding, such as you have a CSPP contract and also a CCTR contract, and you're only using CSPP contract funds for the purchase, you need to indicate why in the justification letter. Bids, if applicable, must be attached to the EPAR when submitted to the CDE for approval. Contractors will be notified within 30 days of approval or denial of requests. To ensure timely processing of approval requests, contractors must include all required documentation when submitting the request. All approved equipment purchases, including costs for labor, must be purchased and delivered by June 30th of the fiscal year in which the request was made. Please keep in mind that end-of-year requests should be submitted to the CDE EED early enough to allow time for approval, purchase, and the installation and/or labor to be completed by June 30th of the fiscal year. Now we'll transition to another type of service level exemption specific to staff professional development or staff training. Education Code Section 8251 allows contractors to be reimbursed for up to 2 staff training days or professional development days each year for training on specified topics. Contractors can be reimbursed for these staff professional development days when they close the program for training or when they remain open during training and hire qualified substitute staff to support programs while staff are being trained. Contractors must request approval from the CDE to close the preschool program for staff professional development. As set forth in Management Bulletin 19-05, contractors must submit a program narrative change request that includes a training topic and submit a revised program calendar to include those as days of closure. These must be submitted and approved prior to closing for the staff professional development days. The EED will inform EENFS or Fiscal Services that these days have been approved, and the contractor will be reimbursed for those days of closure through a service level exemption. Also set forth in Management Bulletin 19-05, approvals for closures for staff professional development are currently limited to the following top training topics for purposes of reimbursement, and they are limited to the following: procedures for emergencies in early learning and care programs, licensing regulations related to early learning and care programs, recognizing and reporting suspected abuse of children in early learning and care programs, managing challenging behaviors and preventing expulsion of children from early learning and care programs, and addressing items on the program's Quality Counts California QCC Quality Improvement Plan. As always, if you have questions related to any requirements for prior written approvals from the CDE, please reach out to your assigned Program Quality Implementation Office consultant. I will now hand it back to Jake, who will go over how to report staff training expenses.
Thank you, Crystal. So as Crystal mentioned, contractors are allowed to utilize up to 2 optional staff training days per year. While staff training expenses have always been a reimbursable CSPP expense, reimbursement may not have been provided due to the limits of reimbursement. Where program reimbursement would have been affected is when their service earnings were lower than their expenses due to being fully closed and not providing services to children on those days. Considering staff training expenses as a service level exemption increases service earnings by the staff training cost incurred. But in order for staff training expenses to be reimbursed as a service level exemption, the training must meet the topics provided in Education Code Section 8251, as Crystal just went over. Unlike the other service level exemptions we went over, staff training days are not a term of the CSPP contract. Over the next couple of slides, we will go over how to report staff training costs and whether days of operation or attendance should be reported. But if a contractor fully closes and no services were provided to certified children, the contractor must not include these days as a day of operation on their enrollment attendance and fiscal report. Contractors shall report staff training expenses in categories 1,000 through 5,000 and identify the amount of staff training reported in these categories on the total staff training expense line located on the fiscal page of the enrollment attendance and fiscal report. Because staff training days are a service level exemption, this identification will allow the CDE to collect the necessary data to reimburse these expenditures and adjust the contract earnings accordingly. Costs that can be included on the staff training expense line include training and travel, and then cost of substitute teachers. As stated previously, in order for staff training expenses to be reimbursed as a service level exemption, the training must meet the topics provided in Education Codes 8251. As long as the training falls within the topics allowed, contractors can report the expenses related to the training on the CSPP enrollment, attendance, and fiscal report. To understand how to report, we will go over two examples. On the left is example 1, where the contractor hires substitutes so that their teachers can attend a training for managing challenging behaviors in the classroom. In this scenario, they hired substitutes to support the program. All sites remained open and services were still provided to certified children. In this example, because the training topic is in line with Education Code 8251, the contractor would report the staff training costs on the fiscal tab of the enrollment, attendance, and fiscal report in categories 1,000 through 5,000, and then identify the amount related to the staff training on the staff training expenses line. Additionally, because services were still provided, the contractor would report the days of operation and associated child days of enrollment in the enrollment pages of the enrollment, attendance, and fiscal report. Now, in example 2, all agency staff attended a licensing regulations training. All the sites were closed and no services were provided to certified children. Because a licensing training meets the topics in Education Code section 8251, the contractor would report training costs in categories 1,000 through 5,000 and include the amount on the total staff training expenses line of the enrollment, attendance, and fiscal report. Because services were not provided, the contractor would not include these days as a day of operation, and they would not report the associated child days of enrollment. Additionally, if this day was originally included in your program calendar, the contractor may reach out to their PQI consultant to submit a request for a calendar change to exclude the days from their operational calendar. Now we'll take a look at how staff training days should be reported on the enrollment, attendance, and fiscal report for a service level exemption. In the reimbursable expenses section of the report, staff training expenses should be reported in the applicable categories 1,000 through 5,000. In addition, those expenses reported in the categories 1,000 through 5,000 related to the staff training days when a contractor is not operating should also be identified on the staff training cost line. So while the contractor has a total of 500,000 reported across expenditure categories 1,000 through 5,000, only 10,000 of those costs were for staff training. As we've gone over, not all trainings qualify to be reimbursed as a service level exemption, although they are likely still a reimbursable cost, but are subject to the limits of reimbursement. For example, the contractor has 2 staff members attending a 2-day CSPP fiscal training. All sites remained open and services were provided, and therefore the contractor would still report the days of operation and child days of enrollment. The contractor would report the training costs for those two staff members in categories 1,000 through 5,000 only, but would not identify any of these costs on the staff training expense line of the enrollment, attendance, and fiscal report. Now, let's look over how other staff training costs that do not meet the Education Code topics should be reported on the enrollment, attendance, and fiscal report. In the reimbursable expenses section of the report, staff training expenses should be reported in applicable categories 1,000 through 5,000. Those expenses would not be identified on the staff training cost line when the topic doesn't follow the topics stated in the Education Code. So in our last example, while those 2 staff attended the 2-day fiscal training, the contractor would not call out any of these costs on the staff training line, which you see here as 0. Now that we have gone over the two types of service level exemptions, let's see how service level exemptions affect your contract earnings. We will not be going over the calculation worksheet in this presentation. Instead, for illustration purposes, we have provided a high-level overview of what the calculation worksheets calculate. For example, A and B, the contract MRA is 2.1 million. The projected service earnings are $2,817,000. And the projected fiscal year net reimbursable expenses are also $2,817,000. What sets examples A and B apart is the reported service level exemptions. In example A, the contractor reported $50,000 in startup expenses and $10,000 in staff training expenses. While in example B, the contractor has no startup or staff training expenses. Because the contractor reported $60,000 in service level exemptions, the calculated projected service earnings adjusted for service level exemptions is $2,060,817. This was derived by adding the $60,000 to the projected service earnings of $2,817. And in example B, because they had no service level exemptions, their projected service earnings remained at $2,817. Remember from one of our very first slides, contract reimbursement in a non-hold harmless year is limited to the following: the contract maximum reimbursable amount, otherwise known as the MRA, the net reimbursable program cost, or the calculated service earnings, which is derived from reported child days of enrollment. Therefore, in a non-hold harmless year, the contract reimbursement for example A will take the lesser of the MRA, costs, or service earnings. While the projected service earnings were only $2,817 after the addition of the $60,000 service level exemption, the service earnings were brought in line with the expenses of $2,060,817. As such, this contractor's projected contract earnings would be $2,060,870. The contract reimbursement in example B, however, would be limited to their calculated service earnings of $2,817, as this is the lesser of the three limits. Let's move to our last slide, which is going to be resources. So here on the last slide, we have resources to assist with the service level exemptions covered in today's presentation. So we have the early education webpage, which includes the EENFS fiscal handbook and the fiscal analyst directory. And we're going to drop a link in the chat for that. We also have another resource, which is going to be Management Bulletin 1905. This will go over implementing optional staff training days, and we're going to drop a link for that as well. Then we have the equipment purchase approval request form, dropping a link in the chat for that as well. And finally, we have the Program Quality Implementation Office Consultant Directory, and we're going to drop a link for that as well. Now we've come to an end to the presentation. I'm going to ask Lucy to step in and begin facilitating the Q&A.